And I heard a voice in the midst of the four beasts. And I looked, and behold, a pale horse. And his name that sat on him was Death, and hell followed with him. And deep inside me, that's how I feel about the current markets at this time. And every bubble we've experienced has had the voices that, in hindsight, offer the testimony to how dangerous markets really were at the time and how obvious the ignored risks were. And yet, the momentum kept rolling. So, let's take a look. Guggenheim Partners global CIO, Scott Menard, said in a letter to his clients that the elevated prices in financial markets show a cognitive dissonance from economic reality that has created a dangerous bubble among debt assets. He went on to say that liquidity from the Federal Reserve and other central banks and increased demand for bonds from ETFs are masking the problems in the market, and the coronavirus outbreak could potentially be the economic shock that bursts the bubble. Menard went on to say that in the markets today, yields are low, spreads are tight, and risk assets are priced to perfection. But everywhere you look, there are red flags. We are either moving into a completely new paradigm, or the speculative energy in the markets is incredibly out of control. But as an opposite opinion is this chart here. In previous videos, we've talked about the Warren Buffett Valuation Indicator. It compares U.S. stocks to U.S. GDP as a signal of how expensive U.S. stocks are. And by that measure, we are near record highs. However, given that many U.S. companies, especially the large tech ones, are global in nature, maybe it makes more sense to compare U.S. stocks to the world GDP. And as this chart here shows, when we compare U.S. stocks to the world GDP, valuations no longer look as extreme as they did in the 1960s or the early 2000s. So, what do you do when you have two such divergent opinions? You take a look at our charts. And today we're going to look at two charts, beginning here with the iShares Russell 2000 ETF. The symbol is IWM. The close on Friday was 167.90, and this is a 20-year monthly chart. And we're looking at the iShares Russell 2000 because this is the weakest of the indices. It's the laggard. It's behind the others. If you take a look at the NASDAQ or the S&P 500, they're much further along in their patterns, much more mature. But here, still, we had this previous top, we had the decline, we had the basing, consolidation, and then move on up. Now, we're not quite at that previous high, but we're closing in on it. Everything looks good from down here in 2009, heading on up. Nice trend line. Everything's in shape. Here we go to the MAC as well. The top, decline, basing, and then upward move with the fast line just moving through the slow line here. It's elevated above zero, so everything's looking good. You can go back here to 2003 and you have a nice trend line, more or less. Here into the histogram, things look good, as well as in the price rate of change. RSI, stochastics, and then the Williams. All cylinders are firing. Backing up here to the price chart once again. Now, this is the monthly chart, and things aren't going to go straight up. So let's just move to the weekly chart and see what that shows. And here we're looking at the 3-year weekly chart on the Russell 2000 ETF. And this, I think, points out some of the problems that I see, the red flags. The first red flag is here. The elevation at this point is well above the 20 and the 50 EMA. Going back here, we had some pretty good elevations at these levels here. And each time we had a little bit of a consolidation. So Right now, that's all I'm looking for is a little bit of a consolidation. As well as the elevated level here, I'm seeing a little bit of a topping pattern. It may break out next week or so, but still right now, it looks like a little bit of a topping pattern, and that's just a red flag. Here into the MAC, we had that top there. We started to decline. We didn't go through the slow line. We reflected on up here, but I think that's because the feds came in with their repo operations and provided some liquidity. So that's another red flag. I like to see this evolve in the next week or two before I really decide if it's going to continue on up or not. But that too is also cautionary. Into the histogram, you can see what I'm talking about there. We're very near that zero line and we may go through it. Now, into the price rate of change, the fast line did go through the slow line. It came back up, but it hasn't been able to come back up and through that slow line. So it's coming from underneath here, and that is a yellow flag. Into the relative strength index, moderate 62.9, but definitely has weakened from this level here. Is it going to make its way all the way back up here into the overbought territory? Not likely. Red flag. Stochastic coming from up and under the slow line after going through here, that too is a little difficult for the market. You can see that it did it back here, but that wasn't necessarily a good sign. We had some trouble in the market during this period here. Also here. So I'm looking for a little bit more strength and I don't see it. Volume looks fine. And then the Williams actually looks okay. It did have a pretty good decline down here. Didn't make it into the oversold territory, but it got close and then reflected back on up here. We're still below that negative 20 line, so we're not back up into the overbought territory. I'd like to get back up there. I'm not sure it's going to make it. We'll have to wait and see for a week or two. So, some mixed signals from the oscillators. It's just giving me some cautionary signals. So I'm sitting on the sidelines. I don't know how long I'm going to be there. And for today, that's ChewDog Charts. Thank you.